Guys, so you are welcome to this session. In this session, we are going to look at variance analysis, basic variance analysis, and then the reconciliation of profits. Okay, so most of the time, when you get such a question, what I would urge you to do is first try to find the profits, because the profits are the most important area that carries the marks before the variance. Okay, so once you are able to get the profits, then you follow up to go to the variance. So you see, we have been given actual information and budgeted information. Now, with this one, the profits have not been given. So you first have to look at what kind of entity you are dealing with and what kind of accounting system they are dealing with, whether they are dealing with marginal accounting system or absorption accounting system. Now, when you look at this, they tell you ABS uses a standard absorption costing system. So with this kind of question, the first thing I would do is to start by compiling my profits. So the first thing I would do is maybe determine the maybe actual profits. The reason why I want to determine the actual profits first is because most of the time it's the actual profits that have a lot of work. And when you get a question that tells you there was no opening and closing stock, you should be happy because whatever they produced is exactly whatever they sold. So this one becomes straightforward. Okay. So if you want to get your actual profit, I will start by my actual sales. So my actual sales, when you look here in the data or the data that is given, they've given us our actual sales units. That is 4,900 and the selling price per unit being 11. So what you are going to do is just take your 4,900 and multiply by 11 cedis per unit. And that will give you the exact value you should be expecting for the sales. That's 4,900 by 11 cedis per unit. That gives us 53,900 as our selling price, which becomes our sales. Not so. Now from there, you need your cost of sales or your cost of production. So cost of sales, we need to work for our cost of sales. So I'll underline it nicely and then start by now, the whole thing about this is that when it comes to cost of production, you need to multiply it by the quantity that you have produced. So if you look at this, we know that we are producing 5,400 units. So when you look at the materials, they have already quantified this in units for us. That means some number of materials were used to make 10,600 kilograms. Okay, so this 5,400, 10,600 kilograms of the material was used to produce that. So we can easily get the cost per material. We know that anytime you are dealing with cost in accounting, it is some quantity times some price, not so. So what we can do here is the same way. It's simple. We take direct material. So let's say we go to direct material. So for direct material costs, we can take our 10,600 actual kgs that were used times the price per kg, which is 0.6 cedis per kg. So what do we get for material then? That's 10,600 times 0.6 per kg. That means you have 6,360 cedis per kg for material. You go to labor. Now you see that the quantity that was given for material wasn't per unit. You get it? You need to also look at that. Because it wasn't per unit, that means this one was exactly, this 10,600 was exactly what they used to produce the 5,400 units. But when you come to labor, they told us that, okay, they used 0.55 hours for every 1 unit that were produced. So if you know this, you can always use ratio analysis to help you in your management accounting. So if 1 labor hour gave us 0.55, not so, 1 unit, or if 1 unit, you can make it, if 1 unit was for 0.55 labor hours, then for all the 5,400 units that we are producing will be how much? So you see, if more, let's divide. So you end up with 5,400 times the 0.55 hours, and that gives us the exact amount of hours labor use. So you can do this as a separate working. Also, can do this as a separate working by taking your 5,400 by the 0.55. That means that, okay, this one was just for 1 unit, but for all the 5,400 units that were produced, the difference is the actual figure is the 2970, and that becomes the hours that were used by labor. Okay, so if that was the hours that were used by, so it becomes 2970, 2970 being the hours that were used by labor. So if this were the actual hours, then when you multiply your actual hours by your actual price or your actual rate, you should get the cost of labor. That's all. That is how you should go about it. So in simple terms, you are just taking your actual hours per unit times the number of units, which gives you your actual hours in total. Then you multiply this by your actual rates that were used, because this one is for 1 unit for all the 5,400 units produced. That gives you the 2,970. Then you multiply by the actual rate. And they said labor is being paid 3 cedis 80 pesos. So with that being said, we can just make it a simple game for ourselves by taking direct labor. Now, when it comes to direct labor, what you have to do is you simply take the 2,970 hours we already calculated, which is 2,970 hours, labor hours, times labor is paid 3 cedis 80 pesos every hour. And if you have used 2,970, we just multiply this by the 3 cedi 80 pesos. Then we get the cost of labor, which is 11,286. Okay, that's the cost of labor. The same way, when you come to fixed overhead needs to be absorbed. In absorption costing, fixed overhead is always absorbed. But the issue here is that this fixed overhead that you see is part of production, right? This is a production cost. So this is already part of production. And now, because this is fixed overhead, actual fixed overhead, it will just make its point to the production process. Okay, so it's as simple as that. This one, we are dealing with absorption costing. So in that case, we have what? Fixed production overhead. Fixed production overheads. So for fixed production overheads, the total value of that is actually 10,300 cedis. Now we put all this together, that gives us our cost of sales. Okay, so that gives us our cost of sales. And we have to actually get our cost of sales before we can take it from the sales, because there's no stock. So 6,360, there was actually closing stock. There was actually closing stock. Why would I say there's actually closing stock? Now, the reason why we are doing all this is very, very important. Now, when it comes to your profit reconciliation kind of questions, you need to be very skeptical, because you need your stock. First of all, you need to determine, so I write valuation of stock as a working. So first of all, what you need to do is that you need to first determine whether there's stock. You see, when you look at the budgeted information, we were selling 5,000 and we produce exactly 5,000. It means that you produce 5,000, you sold the same 5,000. So you have nothing left over as stock. Okay, so when you look at, there's no opening and closing work in progress, you should be careful, because that related to the budgeted information. But when you look at the actual information, we produced 5,400, but we only sold 4,900. Okay, we only sold 4,900. So one thing that they usually do is that students are not aware of this. So when you are valuing your stock, you have to first look at the stock. Are you getting the stock movement? That's the first thing you do in any absorption or marginal costing scenario. So I'll first check my opening stock. There was no opening stock in this question, fine, but there was production, actual production. How much did we produce? It seems in the question that we produced 5,400 units. So if we produce 5,400 units, that means that we actually have available 5,400 units to sell. But how much did we actually sell? So sales, we only sold 4,900 units, which you can see from the data given in the question here, 49 against 54. The difference gives us the closing stock. Okay, now that we've seen this, what we need is that we need to get our closing stock. Okay, so in management accounting, this is one thing I always want you to do, search for the differences in stock when you are told to reconcile profits. So getting the profit itself is the start of the question before you even think about variances. So this gives us 500 units, which are left unsold at the end of the period. Now, these 500 units that are left, they need a value, right? What is their value? So every time we value stock, we always value it at the standard cost of production. Okay, we value this at the standard cost of production, which is very, very difficult to get. The standard cost, you need to work with the budgeted information to get the standard cost for each one unit. And that means that you need to get your standard information. And that is why this thing can be a headache for you because it's two in one question. So you need to speed up. So the next thing I need is I need to get my standard cost of production because that's what I need to use to multiply my stock. So for my standard cost of production, the first thing I need is that, first of all, I need material cost per unit, right? That's the first one that comes to mind, material cost per unit. So how do you get material cost per unit? From our data given here, we are dealing with standard, and you know the standard is the budget in per unit form, is the budget per unit. So now that we want standard material cost per unit or material cost of production per unit, when we come here, we can see that, okay, we have been given quantity in total, not per unit, right? So the quantity of material that is given here, they are all in total. It means that this 10,000 kg was actually used to produce 5,000 units. So if 10,000 was for 5,000 units, then how many quantity or what quantity did we have for every one unit? So we are actually saying that if 10,000 kg of material were actually used for 5,000 units, not so, then how many kg will be required for what? 1 unit, because we need the cost of production per unit. We just want one because the stock, we need the value of one to multiply all the stock of 500 units. So in that case, how many quantities of material would we get then? You get it. So you have to what? Divide. So that means this 10,000 kg will have to divide this 5,000 units so that we get the number of kgs required per unit. Also, so in that case, you have 10,000 divided by the 5,000, and that means you need 2 kgs for 1 unit. So for every 1 unit that you produce, you need to use 2 kg. You're expecting to use 2 kg for this material. But if 2 kg is for 1 unit, then what is the value of 1 unit? Then you are saying that, okay, therefore, material cost per unit is going to be the cost of one material, not so. We need 2 kg for 1 unit, but the price for each material is actually 50 pesos per the budget. You could see. So that gives us the standard cost. So when we take our 2 kg and multiply by the 50 pesos, that means one material actually costs 1 cedi per unit. That means we require material of 1 cedi per unit. So we've got the material cost per unit. When you come to labor, the quantity was already given per unit, right? They give hours per unit. So it's straightforward. You just have to say that labor, okay, is 50 pesos by 0.5 hours. It was actually hours, sorry. 0.5 hours by 4 cedis. We are expecting to charge 4 cedis for the service of labor. And that means labor will cost 2 cedis per unit standard, right? So this is the standard cost of labor. I got 2 cedis per unit. Now what I'm left with is overheads, okay? It's overheads. And we are dealing with production. So it has nothing to do with administration. So when we get to production overheads, remember that when it comes to production overheads, what we do, let's say OAR, right? We need to absorb because you are working per unit. And OAR means that we need our budgeted what? Our budgeted fixed overheads, over our budgeted labor hours, right? So first of all, what we need is that we need our budgeted labor hours. Now note that the production overheads, the OAR that you get is the same as what we call the standard rates. So be prepared to deal with this. So my budgeted labor hours, that's the total labor hours that are budgeted to use during the period, is what I need to get. I know that for each unit, I'm using what? That's 0.5 hours. This is per unit, right? This is just for one unit. So if this is for one, and I know that I'm producing 5,000 units, then when I multiply by this 5,000 units, then I should be able to get the total labor hours that I'm expected to use within the organization. And 0.5 by this 5,000 should give me what? 2,500 labor hours. That means you're expecting to use 2,500 labor hours in the organization. That's the expecting value, which is like the budgeted labor hours. Okay, so now that we know that our fixed overhead, which was budgeted, was actually what? Budgeted fixed overhead. You can see from here that our budgeted fixed overhead was 10,000. So we budgeted to actually spend 10,000 in overheads. Not so 10,000 in fixed overheads, but at the end of the day, we are expecting that this whole 10,000 is for 2,500 labor hours. Not so. So for 1 hour alone, it's going to cost us how much? For 1 hour, every 1 hour we use, how much is it going to cost us in fixed overhead? So if you do the 10,000 divided by your 2,500, you end up with what? 4 cedis per labor hour. That means for every labor hour that is used, our overhead absorption rate or our standard rate for the fixed overhead is 4 cedis per labor hour, right? But if this is for every labor hour, then what is the cost for 1 unit? The cost for 1 unit of a product. That means the cost for 1 unit of a product is this 4 cedis times the labor hour per unit, right? Because it says per labor hour. So if every labor hour we use, it costs 4 cedis, then how many labor hours were actually used per unit? Not so. And it was 0.50. Not so. Remember, 0.50 hours were expected to be used for the making of 1 unit. So if I multiply this 4 by 0.5, that means fixed overhead per unit is going to be 2 cedis per unit. Now, it seems we've got our data that we can use to value the stock. Not so. So in that case, you remember that I told you we use standard cost of production. And to get our standard cost, I think we've got all the data for the standard cost per unit. I think direct material, we had 1 cedi for direct material. Direct labor, we had 2 cedis for this. Then fixed production overhead, we also had 2 cedis for this, right? That means that when you add this, our standard cost of production gives us 5. Somebody will say, but Bill, wait, you didn't consider admin expenses. Yes, when we are looking at product costs are what we absorb into the product. And what we absorb into the product are at the factory level. So simply, we are looking at the factory cost. And factory costs do not include non-production costs. It does not include non-production costs like the admin and selling and distribution expenses. So that means that the data we calculated here, the material 1, labor 2 per unit, and fixed cost, that's 2 per unit, are what we are now going to use to value our stock of 500 units. So in simple terms, you are saying that, okay, the value of the stock is 5 CDs by the 500 units that we have. That means that stock, the value of our closing stock in the actual data we are calculating is 2,500. That's the value of our closing stock. So now that we've got the value of the closing stock, we can actually, because we didn't have any opening stock, I could have even brought opening stock at the top and say the opening stock is going to be 0 units times the 5, which is still 0 because we have no opening stock. But once we are able to get this, which is the sum of all this is the cost of production, right? So the 6,360 plus our 11,286 plus our 10,300 is going to give us 27,946, right? This 27,946 is like the cost of production also, cost of production, how much it costs to actually produce during the period also of the 5,400 units, but we have to less fixed cost. Okay, so I said fixed cost, closing stock, sorry. We have to take out our closing stock, and our closing stock, we have already valued it to be 2,500. So when we take this closing stock out, we can now get our cost of sales also. So this minus 2,500, and that gives us 2,546. Okay, so now we can get our gross profit. And because you are doing absorption costing, this is straightforward. We can get our gross profit. Now that we have our gross profit, we have our cost of sales, and then the sales, we can take it out from the sales. And when I deduct this from the sales, this from 5,900, is going to give us a gross profit of 28,454. But here lies the case, there's administrative expenses, fixed admin expenses, which are non-production costs, right? Is per the question, is given per the question. And I think under the actual costs, we do have we do have 3,100. So 3,100, that becomes our admin expenses. So if we subtract this, that was the only non-production cost that we had. That means we can get our actual profits for the period. That means our actual profit is just our figure minus our admin expenses, which is the only non-production cost, and that gives us 25,354. That gives us 25,354. Now, for the budgeted profit, you need not do the same thing because the examiner is not so hard-headed, or his head is not that hard, okay? So when it comes to the budgeted profit, because the sales and the purchases, or the sales and the production are the same, it means that there's no opening and closing stock. So you can just get the profit per unit and multiply by the number of budgeted units. Okay, so if I want the budgeted profit, is just so easy. What I'll do is just get my budgeted profit per unit and multiply by the number of units. So I know that my standard cost per unit is actually how much? My standard cost per unit is actually, I think I had 5, not so. And then the budgeted units is actually 5,000, not so. So I know this by this must give me the budgeted cost, not so. this will end up giving me the budgeted production costs. So the budgeted production cost is actually going to give me 25,000. Then there's another additional cost I need to add. Remember, the non-production cost, the admin cost is also, the admin expenses is also a cost. And that one was 3,000, not so. Yeah, so when I add this, that means I have 28,000. And this 28,000 is actually what? The total cost that I have. So if this is the total cost, then straightforward, I can't get my profit, because if this is total cost, I know that sales, I know that when I deduct this from my sales, I can easily get what? So I need my budgeted sales. And according to my budgeted sales, I am selling 5,000 units, and each unit I am selling at 10 cities. So if I'm selling each unit at 10 cities, 10 cities times 5,000 is going to give me 50,000. So if total cost is 28 and sales is 50, what is my budgeted profit? Or my budget profit? So comparing this, 28,000 minus 50 minus 28 is going to give me 22,000 as my budgeted profit. Okay, so now that we've got this, what I want you to do is just to set up a pro forma, which you need to use to get your figure. So how we do budget reconciliation is that reconciliation statements are quite easy. What you need to do is that you bring your budgeted profit. Okay, so first of all, I'll just bring favorable variances, adverse variances, and then I bring my Ghana city here. But what you start with is your budgeted profit. Okay, so we must work back to get our actual profit. So I take my budgeted profit, which is 22,000, not so, and then I must add all favorable variances and less all adverse variances to arrive at my actual profit. And my actual profit that I had in the question per my calculation that we did. So this is how I go about it. So I work both profits. I work both profit. This was 25,354. I work both profits and then put them where they are supposed to be. So 25,354. So in between, when I work any variance, I slot it in. So from here, I'm going to start working on the variances. Then I'll be slotting them in. So let's first start with material. So when it comes to material cost variance, I use the simplified approach. Okay, so in the exam, you define that let SQ be equal to maybe standard quantity to the examiner. And also let SP be equal to a standard price. And maybe let AQ be equal to actual quantity. So you define for the examiner, and AP be equal to actual price. So always make sure you do this so that the examiner knows what variables you are using. So I'll first start with my standard quantity times my standard price, and then my actual quantity times my standard price. Then finally, I do actual quantity times actual price. And then when you dive into the data, you realize that, okay, what are you looking for? What's the actual quantity of material? You go to the actual site that has been given as 10,600. So I just pick my 10,600 here, and you can see actual quantity also here. I put it there. What was the standard price of material? You go to budget, you find your standard price there per kg, right? Price per kg is the standard price, is 0.5. So here I see 0.5 here. I see 0.5 here, but I need the actual price. You go to actual, you see that the price is 0.6. Actually, you were supposed to buy materials at 0.5, but you bought it at 0.6. This tells you that there's been an adverse variance, but don't worry here. All you have to do is fill in the data. Now note, anytime you see standard hour or standard quantity, it's always of actual units produced. Okay, so always always the standard, whether standard hours or standard quantity, is always multiplied by actual units produced. So when you look at the standard quantity, we do not have the standard quantity per unit directly, but you remember that when we were working the standard cost per unit, we had it. So we can just go there and say that, okay, 2 kgs were actually used to produce this, where was it? The material cost that we got, the standard, we realized that it was 10,000 for 5,000 units. So 2 kg was used per the standard, but this was per the budget. So we need the actual, right? So in that case, we know this was 2 kg. And if 2 kg will always be multiplied by the actual units produced, the actual units produced was 5,400 units. Always make sure you remember to multiply by the actual units. So standard is always like what we call the flexed, okay? We flex it. We get the per unit and now multiply by the actual units produced. So once we have this, we have our 2 kg by our 5,400. It means that we were expecting to use 10,800 at 50 pesos per unit. So that gives us 5,400 Ghana cedis. Okay, so 5,400 Ghana cedis against this. So we have 10,600 at 0.5, and that gives us 5,300 Ghana cedis. And we also come here, we have 10,600 going for 0.6. That gives us 6,360. Now that we have this, we can equally get our usage variance, which is the difference between this and this. So we have 5,400 minus 5,300, and that gives us our variance, which is 100 cedis, favorable variance for usage. And in actual sense, it makes sense because we use 10,000, we wanted to use 10,800 kg to produce, but we ended up using 10,600, meaning we have saved about 200 kg, right? And that 200 kg each is 50 pesos. So we ended up saving about 100 cedis favorable Ghana cedi. So 100 cedi cost has been saved, which is favorable to our business. So that's what it means. When it comes to the price, it should be adverse because we spend more. So price is just the difference. So it's top minus bottom, 5,3 minus 6,3, 60. And the difference is the variance. So 5,3 minus 6,3, 60. And that gives us 1060, 1060 adverse. So I've got the two variances, and now I need my total material cost variance. Okay, it's not necessary here, but since you already have it, so you have this being adverse, this being favorable. So if I add 100 to this, I have 960 adverse. Okay, so when I go to my variance sheet, I'll come here and then you just put in whatever variance that you have. But mostly we start with sales, but it doesn't matter if you are against them, whichever variance you put doesn't matter, right? But they arrange it in a particular order, but don't worry. So I will start with material price. Material price was 1060 adverse, meaning it's negative. So anything here is adverse. Remember that it's negative. So if you like, just put a negative there. And then material usage was 100 favorable, no, so it's positive. So you can put the positive in front, okay, just to help yourself. So don't finish with everything before you start constructing your statement. Immediately you start, you can start constructing your statement. So we are done with material, and the next variance we can start looking at is labor. So when we come to labor variance, we can say that, okay, the same way we did for material, labor deals with hours. And the same way you say, let standard hour be equal to standard hour to the examiner. You define your variable. So standard hour times standard rate. Then we do actual hour at standard rate, actual hour at actual rate. Okay, so when we dive into the question, we just start with the actuals because it's easier to pick from there first. So when you come to labor, I think we have actual hours that were used, but they were in units. They were per unit. For 1 unit, we can get a total, right? Because if 1 hour is 0.55 and actually we produce 5,400 units, you see, everything is always multiplied by the actual units produced. Most questions give it to you directly, like the way they gave us 10,600 for the material. But if they don't give it to you, actual is always multiplied by actual quantity. So if for 1 unit, this is for 1 unit, right? So if we want for all the 5,400 units, we must then multiply by this to get our figure. And doing variance questions that are like this can help you become very solid. Okay. And this one, we could even go to pick it from the earlier question that we were dealing with. We could pick it from the earlier question that we're dealing with because we got the figures from there. So 0.55 by 54, that's 2970, which we got earlier. You remember? So this one by the standard rate, and they give us the standard rate for labor. The standard rate for labor was 4 cedis. So we have to use this 4 cedis throughout. So labor, 4 cedis here, 4 cedis here, but the actual rate was given as 3 cedis, 80 pesos. Okay, so labor is favorable. We expected to spend 4 cedis for labor, but we spent 3 cedis, 80 pesos. So when we come here, the actual hours that were used was 0.55 per unit, but we actually produced 54. Not so. We multiply this by this. But when we come to standard, we use 0.5 hours. Not so, but it's always by actual. Remember that I told you standard is always by the actual. So once we have been able to do this now, we can then get our figures and get the necessary variances. So the first one, we have 0.5 by 5,400 by 4. And that gives us 10,800 as our standard hour by standard rate. We come here, we have 0.55 by 5,400 going into 4. We have 11,880, and this one we can establish our efficiency variance also. So for efficiency, we have 10,800 minus 11,880. That means this gives us an adverse variance. So 10,8 minus 11,880. This gives us an adverse variance of 1080 adverse. So when we go to labor rate, let me just do the last one, 55 by 54 by 3.8. That's 11,286. So if I come to my labor rate variance, my labor rate variance rate is 11,880 minus 11,286. So that means rate is 11,880 minus 11,286. And that gives us 594 favorable variance. So if I should put my total labor cost variance together, I have negative 1080 plus 594 favorable. And that gives us 486 adverse, right? 486 adverse. But all you have to do is you need the individual variances. So I have efficiency negative. So I come here and say what? Labor rate. The rate variance was positive. It was positive 594. So 594. Then labor efficiency, it was adverse 1,080. So I put it in that column. So you can do it this way and you realize that you start moving. You don't need to finish everything before you decide putting everything in its place, right? So as and when you solve the variances, you just fill in. So now we are done with this and we are done with labor. Now we come to fixed overheads. I think this question was relatively simple. Now, when it comes to fixed overhead, you follow the same path, but you just slot in one new line item. So you start with your standard hour times your standard rate. You come to your actual hour times your standard rate. Then you come to you leave at least two spaces worth and just do actual hour times actual rate. But you slot in something new, which is your budgeted hour by standard rate. The reason is because of absorption. And absorption costing, we absorb, so we need the capacity to absorb. And when we are doing OAR is the budgeted hours that we use. That is why we bring in budgeted hours. So here you just fill in. And how do you get your standard rate? Remember, your standard rate is the same as your OAR. And we had already calculated this when we're about to value our stock. We went to do OAR, you remember. And all these things that you did earlier are going to help you. So we come here and pick our standard rate of 4 and then use it to go and work. So we come here, we know this will give us 4 CDs. This will give us 4 CDs. This will give us 4 CDs. This one is actual rate. Actual rate. Were we given actual rate? No, we weren't given, but we're given the actual fixed overhead costs. And the actual fixed overhead cost was what? 10,300. We could just pick it, which makes it very easier. So now what we are doing is that fixed overhead, what's a standard hour for fixed overhead? They are absorbed in line with the labor cost because it's labor who uses overhead. So the same hours, right? Unless you are specifically told in a question you are using machine hours, all overheads use the labor hour. So labor hours, we know the standard was 0.5, and also, and 0.5, the actual unit produced was what? 5,400. When you come to the actuals, actual labor hours that was used was 0.55. You can see from the question, also by the 5,4. When it comes to the budget is the same as the standard. So that one is still the same 0.5 per the standard, but here, because it's budgeted hours, we use this to multiply the budgeted units. And the budgeted units was 5,000 produced and sold. So that is how you go about it. Then the actuals is just 10,300. So with this, we can work our way up. So we have 0.5 by 5,000 by 4, not so. And that gives us 10,000, not so. Then you have 0.55 by 5,400 by 4. Then that gives us 11,880. We've seen this somewhere. Then we have 0.5 by 5,400 by 4. Now this gives us 10,800. Okay, so this is what we have. It's similar to labor, but there's something new in there. So what we can do is that the difference between the first two is actually efficiency. Okay, efficiency, and that's 10,800 minus 11,880. And that means we have an adverse efficiency variance. So 10,800 minus 11,880. That gives us 1,080 for labor as well. You remember the same variance, adverse variance, because you are using labor hours, but it's not always the case. It's just that the rates are the same. Sometimes the overhead rate is different from the labor. Here it's just a coincidence. So we come here. The difference between this is capacity. So when you come, that's the second one that follows capacity. That's 11,880 minus 10,000. So capacity variance, you realize that is favorable 1,880 favorable. Now, one thing you should understand is the sum of your capacity and efficiency. So efficiency plus capacity is equal to the volume variance. Okay, so fixed overhead is actually made up of fixed overhead volume and expenditure, but you can break them into sub variances, which are efficiency and capacity. Okay, so I usually decide to add up the efficiency and capacity to get the volume. And this is negative 1,080 plus 1,880. And that gives us 800. favorable. Okay, so 800 favorable becomes our volume variance. Then when it comes to the fixed overhead absorption or the expenditure variance, fixed overhead expenditure variance, one thing you realize is that we have 10,000 minus 10,300, which means that we overspent for overheads, not so? So in that case, we're expecting to spend 10,000, we spend 10,300. That means there's a 3,300 adverse here, making our fixed overhead variance, fixed overhead variance adverse, not so. That means an adverse favorable variance of 500, not so overall. So that is fixed overhead. It could be quite confusing, but work your way through these examples a couple of times and you should be okay. I think this question is good enough to teach you everything about variance. But most of the time, when students do these complex ones, when they see simple ones, they can't do it because the simple ones, the actuals, mostly they are compiled for you. They put them into one. So with that kind of questions, you don't usually struggle, but because you are used to the complex ones, you struggle. So now that we have fixed overhead, we can just head over here and just say fixed overhead expenditure. The expenditure was what? When we go back, we see that fixed overhead expenditure was 300 adverse. So we just put it here minus 300. We come here and say fixed overhead. If you like, you can just say volume also and just give them the volume, which was 800 favorable also. Then you are good to go. If you like to, you can expand it into capacity and then efficiency. It's up to you. Now, the fixed overhead variances can be used to compile what we call control ratios. So you see how I've arranged them. You can use them to compile control ratios. And let me show you how to do that. It's very easy. You know the fixed overhead, I did standard. I'm only looking at the hourly part, the hours that were used, the efficiency and the capacity part. The volume part can be broken into ratios, okay? So you see we did standard hour times standard rate. We did actual hour times standard rate. And before the last one, we did budgeted hour times standard rate. And also now, assuming we are doing ratios, we don't need the standard rate. So usually I do this and then take the rates off so that it looks very interesting. Now we know that between this one and this one, we had, you remember, between this one and this one, we had efficiency variance. So this one becomes the efficiency ratio. Okay. And between this and this, remember the first one, we had capacity, but this one becomes the capacity. This one becomes the capacity ratio. Okay. Capacity ratio. And then you realize that when we were doing addition and subtraction, we got total. Here we are multiplying and dividing. So you remember efficiency plus capacity was volume. Here, because you are doing division and multiplication, instead of adding here, you multiply. This efficiency ratio times capacity ratio must give you the volume or the production volume ratio, okay? Production volume ratio, or some people call it the activity ratio, okay? So if you don't get production volume ratio, another name for the production volume ratio is the activity ratio. And you can use the same data that we used. Now, when you look in the question, assuming I want to do this, you realize that before is SH minus AH, right? But because here we are dividing and multiplying, it's just division. Anything you were subtracting when you were doing the actual monetary variances, when it comes to ratios, you are dividing. So looking at this one, per the information that we have, we knew that our standard hour was by standard rate. And also in standard hour, we knew that labor, standard hour 0.5 hours, but we were actually producing 5,400 also units. So this one gives us our standard hours that were used. When we go to our actual hours, we know that we were using 0.55 labor hours by the same 5,400 hours. Not so. That is what you got. Then when we go to the budgeted hour, we realize that we're using the same 0.5 hours, but because this one is budgeted, we use the budget, which was 5,000 hours. So now if we want to get the figures that we need, then we know that, okay, if we get the figures, we can do whatever we want. So 54 by 0.5, that means here we get 2,700 hours. Okay, so these ones are hours. Then 0.55 by 54, we get 2,970. You remember this 2,970 that we calculated, the 0.5 by 5,000 hours for the, and that gives us 2,500 labor hours. Now, we know that when we want to do efficiency, is this minus this, but here, because we are dividing, it becomes efficiency variance becomes 2,700 over 2,970. And these control ratios, when they are greater than 100, they are favorable variances. And when they are less than 100, they are adverse in nature. So for this one, you see straightforward, just take from the top and just divide. So this by this, we get efficiency, which is 2,700 divided by 2,970. And we had an adverse variance of 0.9. So you can use it in decimal. Let's just make it 90.9% adverse, right? This is adverse, 90.9% adverse. You do the same for your capacity, which is actual hour over budgeted hour. And this is the figure you are going to get for capacity. And capacity will just be 2,970 over 2,500. Simple as that. And what do you get then? That's 2,970 over 2,500. You realize that that gives you 118.8. So 118.8% favorable. And you could see that truly our capacity was favorable and our efficiency was adverse. Now, when you multiply these two, you should get your production volume or your capacity. Very straightforward. So this by this must give us that. So we have this by our 90.9. You have 107.98% favorable, just like we did. So the same way, you can just move from the top to the bottom, and this same thing will just give you a standard hour over your budgeted hour because it's from the top. And that means you are just doing 2,700 over 2,500. And that is actually favorable because it's more than one. That still gives you the 107.98 or simply 108% favorable. Okay, so this is how the control ratios or the labor ratios work because they are using labor hour. It's not anything difficult. So it's just the fixed overhead variance, which is put into hourly form. You are just looking at the hour part of it. Okay, and just know when to divide and multiply. Okay, but that being said, the last thing we need are actually our sales variances. And actually for sales variance, you need two things. It is always made up of sales volume. You know, to sell, you need the volume, the quantity sold, and you need the price. Okay, so sales variances are always two, just like all other variances. We have sales volume and sales price. The quantity variance and the price variance. And sales volume was directly given to us in the question. So our sales volume is actually the variance is giving us our actual quantity minus our budgeted quantity times our standard profit. Wow, that is our standard profit. So here lies the case. We need our standard profit. And you know that per this question, we have our standard cost, we have our total profit. We can easily get our standard profit. How? Because if our budgeted profit is 22,000 and this 22,000 was actually for 5,000 units, then we can get the price for 1 unit. We can get the profit for 1 unit. So 22,000 was our total budget profit. Divide this by the 5,000 units produced and sold. That means our standard profit is actually 4 cedis, 40 pesos. So if I want to do this, I know that my actual quantity that was sold was actually 4,900 units, and the budgeted quantity was 5,000 per the budget. Now, the standard profit I have got as 4.4. If I should multiply this, I know that my sales variance is going to be adverse. This minus 5,000, negative 100 plus by 4.4. So we have 440 adverse variance for my sales volume. Okay. Now, when it comes to sales prices, the difference in price. So that's volume. Now, if I need sales price variance. So for my sales price variance, the difference in price. And the variance is actually your actual price minus our budgeted price or our standard price, all times our actual quantity that was sold. And our actual price for this was 11 cedis. Budgeted price was 10 cedis. Actual quantity sold was 4,900. So when we deduct this, we have a favorable variance of 4,900 favorable because this will result in 1. So this is a favorable variance. Now, when we come back to our variances, sales variances are supposed to come up, but don't worry. So I will just bring my sales price variance. This one, I knew it was a 4,900 favorable variance. And then I have my sales volume variance, which was an adverse variance. You can see from the calculation was adverse 440. So that 440 is adverse. So I'll just bring my 440 here negative. So once you have been able to put all your variances together, you sum all the negatives and the positives and put the totals here. So when you look at all the favorables, you have 100 plus 594 plus 800 plus 4,900. Okay, so putting this together, you have 6,394. And you take the negatives too, which is 1060 plus 1080 plus 300 plus 440. That gives you 2,880 negative. So you're actually saying 6,394, 6,394 minus 2,880. Sorry, I got a syntax error. That gives us 3,514. Okay, so if you add the two, that's 22,000 plus 3,514. Get 25. It's closer. It's closer. So I think maybe we might have committed 1 or 2 errors, but the figure is almost the same. I think it's short by hundreds, about 200, 200 and 100 and something. Let me see, this minus 2, 5. Yes, yes, yes. There's one more variance we forgot. There's one more variance. That is why it is not balancing. There's one last variance, sorry. I didn't bring that variance, and that variance is the admin expenses. So for the admin expenses, there's also a variance. So we have the standard or the budget. The budgeted admin expenses was 3,000, and then the actual that we spent was 3,100. So we actually spent 100 extra. So this is 100 adverse, and this is an extra adverse variance. So Where's our statement? So somewhere down here, I have to bring in that variance. Admin expenses variance, but it's the understanding that I want. So let's see, admin expenses. So administrative expenses, I think that one was a negative 100. So if we should put all together, think all the totals, we have 100 for the top plus 594 plus 800 plus 4900. That gives us 6394. This one gives us 1060 plus 1080 plus 300 plus 440 plus 100 plus 2980 adverse. So when we put this together, we have this 6394. That's 3414. So most of the time, once you add up the variances like this, you just ignore because you've already put your actual profit there. And I think there might have been some small mistakes with the actual profit, but the variances are correct. Okay, so 25414 is closer because 414, I think there's some 60 that we forgot somewhere. It's no big deal. It's closer. So you should get your marks. Okay, so that was just by the way. Make sure you practice again, try your hands on these variances. And then when you get such a question, you can deal with it. Okay, so we'll be doing more and more as we go along. And I'll see you in the subsequent sessions.